and welcome to the last Bondcast of 2023, a podcast series where we discuss our views on the recent themes and events shaping rates markets. I'm Imogen Bachra, head of non-dollar rate strategy, and I'm joined today by our global market specialists, Nevruzi and Joann Spadigam. Okay, a central bank bonanza to round out the year. Let's start with the Fed, with you, Jan, because I think arguably they were perhaps the most interesting central bank this week and certainly really the biggest market mover. They were about as dovish, I think, as you can get, and certainly more dovish than we were expecting. Maybe you can just run through the kind of details from what we learned from the Fed this week.
I mean, it was really a remarkable meeting. You didn't have any of those dovish dovish statements combined with a hawkish pressers. It was just one tone, encourage the rally. We don't, yields lower. It's just nothing, zero pushback. Complete smooth glide path to lower interest rates. But to recap what we got, right, the Fed didn't hike as expected. They left their interest rates unchanged in the range of 525 to 550. But what was more impressive and what really the dovish delivery came from was the other material that's submitted alongside the decision. So every other meeting, the Fed submits their forecast, not only for inflation growth, but also the committee's estimates for what the rates will be in 1 year time, 2 years time, the longer run estimate, and so on. Those are called the Summary of Economic Projections, the SEP, and those came in on the softer side of what generally the views had coalesced around. And for people who don't track these things as closely, this might seem like reading too much into the tea leaves, but there is a little bit of almost like a reflexive reaction between the kind of the forecasting community and the Fed and what markets are also pricing in. So when the Fed knows that most people are looking for let's say a 50 basis point cut or a 75 basis point cut, if they choose to go with the 75 basis point option, they're going to be sending a signal to the market, even if the pricing is different than that. And that's exactly what happened. The discussion was whether the Fed is going to show rates going to 4.875 from the current 5.375 or to 4.6. And what happens? We got the 4.6. So they indicated that we will get 75 basis points of total rate cuts next year, then another 100 basis points in 2025. That brings it down by another 25 compared to September. That's a material shift compared to their latest set of forecasts in September, when the estimate for next year was only rates going down to 5.1%. So a substantial change, as you can see. And really, if you look at the weeks heading into the meeting, we had some data, but nothing really screamed that they need to make this type of a major adjustment to the more dovish side. What had changed was markets rallied a ton. Futures markets, where we can gauge what market investors anticipate, or at least are pricing in for the Federal Reserve interest rate to be at any given point. Those expectations came down significantly. And what I think happened was the Fed wanted to encourage that direction, and they just simply leaned into that pricing. If we didn't have those couple of weeks of rallies, I think they might have actually stuck with the 50 basis point a more middle of the range expectation. So that's first. The forecast came in pretty soft, pretty optimistic that rates can come down. They also lowered their inflation expectations for next year from 2.6 to 2.4. And then finally, the statement was also changed to show more emphasis on slowing growth, which they pointed out this time. Of course, Q3 was very, very strong in growth terms, so they had to, I guess. They could have not, but they still chose to point that out, that growth has slowed down from that pace. They also pointed out that inflation has slowed down, another positive kind of like a hint towards them getting closer to their goal. So at the 2 p.m. release, everything looked very, very kind of like leaning towards the dovish side, like I said. And then, half hour later, we got the press conference, which, I had my suspicions that it might be kind of one of those trade-offs. But of course it wasn't, and hence the massive reaction that we got in interest rates. The press conference, you got questions such as, "Well, are you guys talking about interest rate cuts now?" And usually that would be a question that would be pretty quickly dismissed as, "We're not even, at that point of discussing these things. This time, Chair Powell said, yeah, we have actually discussed that at today's meeting when he was asked if he is worried about financial conditions loosening too much and undoing some of their progress in inflation. The answer was no. I mean, just completely sidestepping the question, not really kind of, saying that it's a trade-off of some sort. It was pretty much I'm not really concerned about it. There was a lot more focus on the Fed's dual mandate. The Fed in the U.S. has inflation and unemployment as mandate, and until now, it was almost completely lopsided towards inflation. This press conference, the sentiment shifted a lot more to reflect focus on unemployment too. Additionally, Powell emphasized that they will be cutting rates well before inflation gets to 2%, because they understand that traction, or at least momentum, works in both ways. And once inflation starts accelerating and unemployment starts going up, it will likely continue. So they don't want to overshoot on unemployment and be too late to the party. And that whole thing led to almost like it did lead to a 30 basis point intraday swing in 2-year yields, and that's the largest single day move. Really, if we exclude the SVB period, where it was a very disorderly period of disorderly unwind earlier this March, it was really the largest single day move in the 2-year note.
All fun and games then. So how does that leave your market views then? We've talked a lot on this podcast before about how certainly for the ECB and the Fed, we had a much more dovish view than the market. Not that for the Fed, we had particularly early cuts being priced in necessarily. We expected them to go in May, but once they start going pretty aggressively, and others, certainly other kind of sell-side analysts had much more hawkish forecasts that all now seem to be kind of revised in a more dovish direction. Market pricing has obviously come much more on board with our view. And, when we came in London hours this morning, people have started talking on the morning call about January being live, for example. So how does this leave your market view or your rates outlook going forwards?
January pricing has seen some leakage. If you just look at what the curve is reflecting, it actually has a couple of basis points of cuts priced, and of course that's probably just a residual of kind of a residual of the duration flows towards the March contract, and maybe also alternative kind of technical factors that I'm not going to get into for purposes of this macro discussion. But I mean, we always have this discussion even on the desk, and I tend to be the more kind of dovish one on the Fed. And I, at some point, anticipated that this type of shift would have happened and would have been met with a strong market reaction like this. But it seemed too soon to happen in December, so it even beat my expectations. And I'm kind of getting a little worried that we're reaching our year ahead targets in like 1 month's time, and we expect this to be more like a Q1 development and not so much like a December meeting. But I guess that is Chair Powell's Christmas gift to bond bulls, and with that being said, I still think we will see further rallies in the front end. Those kind of that gate has been open. It's just I'm getting a little worried about the pace of it and how fast we got here. So, of course, this is not like the venue where we discuss specific trade ideas, but I think generally my thinking around here is what can cause the curve to steepen here, because earlier today I was looking at some historical periods where we've seen the curve steepening, so longer yields moving higher or ending up higher than the shorter dated yields, and it's really hard to find cases where the steepening is not driven by shorter dated interest rates coming down. So unless you really start going to like the 80s and so you don't really have these major reshifts in the curve with the long end selling off. So it is a tough question to see what drives it without further pricing in of interest rate cuts, and we've done a lot. So what I'll be looking for is just some expressions of long duration, but maybe make you carry even worse, because being outright long in twos as negative carriers. So maybe add some hedge onto it, kind of like some tail hedges that have lower delta on them, and try to protect in case we retrace back a little bit, because you never know how data works. Maybe you just get like some monthly resurgence in jobs and inflation in January, and we kind of claw back another 40, 50 basis points. Even though it seems hard to think of after today's moves, I think something like that makes sense as we kind of head into the new year. And it's like short-term expressions, but I don't know. I haven't really changed my view on kind of like a more medium or like longer-term macro view to say, you know what, we're going to get to 3% in twos, and then you're going to see the 10-year yield selling off to 4.5%, 5%. So I don't know what causes that, and this is going to be the discussions that we will be having internally as well. But it seems like the curve should have been steeper at this point, and it simply didn't get there. But the cost of holding those steepeners is actually getting more and more punitive. So let's see. I think duration does well, but I'm a little bit more cautious into year, and I'm not really giving too much of a sensationalist juice here to listeners. But it's going. I think given you had 40, 50 basis points of rally in the span of 2 days, it's hard to maintain your conviction. When rates rally, I just take off longs and and vice versa. So.
Well, perfect timing for a Christmas break then, and we can reassess
Exactly.
back in January. All right, Joann, let's move over to Europe, where we are recording this literally just after the ECB today on Thursday. The ECB left rates unchanged, as was broadly expected, but I don't think that was really all the market's focus heading into this week's meeting. As we discussed on this podcast last week, the one thing that we would be watching most closely was the revisions to any of the projections. So perhaps you can talk us through what we learned there and how that kind of fits versus our expectations.
So the growth in the inflation forecasts for this meeting were revised lower, as we expected. But I do think what this does more than anything is actually set up March for further revisions downwards in the inflation forecast in particular. So we're on the more dovish end of inflation projections, sort of expecting inflation to come back to target faster than the ECB. And I think what was also interesting in the forecast was that actually the medium term 2025 inflation number that was given was 2.1%, which is still above 2%, and I suppose indicates that inflation is not going to be at target in 2025. So we do think that is worth a shift in the March meeting. So we do think that this is the initial sort of step before March meetings have a further revision downwards for the inflation forecasts. I think what was also interesting from this meeting was Lagarde seemingly being a bit more hawkish in the press conference, whilst this policy statement was dovish in the sense that it contained downwards revisions to inflation and growth. So, I think that for the press conference, what we did see was Lagarde pushing back a little bit on market pricing. She did note that the inflation forecasts that they had put out were conditional on a market path that was higher than what was being priced in at the moment. So that to me suggests that she is pushing back a little bit on this fairly big rally we've seen off late, and that does suggest that perhaps the path for interest rate cuts and the amount of cuts being priced into next year is a bit too stark versus what the ECB wants markets to be pricing in at this stage.
We expected some kind of discussion around balance sheet reduction, but we didn't expect a concrete announcement, which we ultimately got. Can you talk us through what that announcement was and why you think that they decided to surprise markets with something like that so much earlier than expectations?
So the PEP announcement did come earlier than we expected, and I think the general theme I've noticed amongst the sell side is that no one really, not many people at all, were expecting that the PEP announcement would come in December. But I think what was positive from the discussion was that really the timeline announced was that PEP will stop in mid 2024, along with the pace of PEP only rolling off gradually was in line with our expectations. So PEP roll-off will amount to around 7.5 billion per month in the second half of the year, and then end in full at the end of 2024. And I think that roll-off profile and that timing is very much in line with what we expected, even though the announcement coming now was a bit more unexpected. But I think even with this sort of surprise announcement on PEP, what was really interesting was what happened to BCPs, where we saw them, the spread tightening another 4 basis points once PEP was actually announced. To me, that was a bit surprising at first, but I think perhaps markets are seeing a clearer path, at least for PEP, which has removed some of that uncertainty that would have caused the BTP to widen. And I guess the second point as well there is that with the timeline announced, what we do know now is that into another year of heavy supply, the ECB has maintained the flexibility in PEP with only a gradual reduction. So from the middle of the year to the end of the year, even though PEP is being unwound, they are only doing it partially, which does allow some flexibility to be used if needed. So perhaps that did come as a positive to markets when they were thinking about PEP this time around versus the kind of widening that we expected when PEP was announced.
I guess same question to you then that I asked Jan, like how does that leave your market views now? I mean, exactly the same as I said to Jan, you guys have had this more dovish view on European rates. Back in September when we kind of first published that view, it was like so off consensus that people didn't even really want to hear what we thought about it. And now it's so on consensus that no one really cares because everybody else thinks the same thing. So how are you thinking about like the rate outlook and markets from here?
So I think in terms of the rates outlook, I think we had a bit of a pullback in rates just in the kind of pricing for front end this afternoon after the Fed meeting caused a bit more of a rally. So like the market is pricing in around 17 to 16 basis points for March. I think that looks about fair for now. I think, there are obviously risks to the inflation outlook that could come in January and December with the wage inflation rounds actually being actually happening then. And equally, there's this risk that the ECB stays where they are and that they're restricted for longer mantra that they continue to hold does mean that rate cuts are delayed. So I do think that pricing for March at the moment looks fair. I think that where we could see correction into next year is the amount of cuts being priced in to markets, where if we do get a picture where growth is relatively steady in the euro area, the onus or the I suppose the what drives the ECB to cut faster probably isn't the growth picture. So we could actually get a rate cut picture that is a bit more shallow than what's being priced in at the moment. But I think that in terms of overall rate markets, I mean, I think I very much share Jan's kind of concerns where even though we've moved so fast, so quickly, the question does become what causes the market to pull back. I suppose in January, the key focus could potentially move to the inflation forecast once again, or the inflation numbers coming out in December for the December month. And we do think there's a temporary shift upwards in the inflation numbers for December due to base effects. So perhaps that tick up in inflation could mean the markets give up a little bit of what we rallied so far, or perhaps the supply picture adds some upwards pressures to rates. But I think overall for next year, our views very much remain the same, where it's very difficult to look at anything but a steepener, I think, into a year where the Fed, ECB, and Bank of England are cutting, even though near-term risks are potentially skewed differently. I think for BTPs, we've been on the more bearish end of the spectrum on BTPs so far, but it seems to me that after this PEP announcement actually came as a positive for BTP spreads, that this widening risk that I saw in PEP is probably not it's not significant anymore. And with the positive stories we've had for BTPs this year, with strong retail supply making up for any sort of issues with NGU funding, as well as I suppose the stability and growth path where Italy is not as negative as France, for example, in terms of how they see the outlook. I do think that the more negative side for BTP seems to have faded at this point. So we are neutral BTPs at this point versus being more bearish as well. So in terms of central bank meetings, then let's move back to the UK, where we also had the Bank of England meeting today, which came in line with expectations. So what are the key takeaways from there?
Yeah, I guess on the surface, this was very much a kind of boring, so to speak, and consensual Bank of England meeting. Anyone who listened to the podcast last week will know that we were expecting unchanged rates, unchanged forward guidance, and a 6-3 vote. And given that it wasn't one of the Bank of England's quarterly meetings where we get updated projections and there was no press conference, they were really the only three tools that the bank had to kind of steer markets or a market reaction. In the end, that was what was delivered: unchanged rates, unchanged forward guidance, and a 6-3 vote, which, like I say, on the surface feels fairly consensual. But I think in the context of what we've learned this week, both from the perspective of the downside surprises in the data in the UK, so we had downside miss on GDP, and we had wage inflation that came in lower than expectations as well. And then we also had, clearly overnight, this very dovish pivot from the Fed. I think that the two of those things had kind of marginally shifted expectations in a slightly more dovish direction. And so, the Bank of England delivering on last week's expectations actually at the margin was slightly more hawkish than kind of this morning's expectations, let's say. For me, I think there were two key takeaways. A is the fact that the Bank of England remained quite nervous about the upside risk to inflation. They talked a lot about not wanting to overinterpret one data print when it came to the kind of more favorable trends in wage inflation. They talked up the upside risks related to service inflation remaining high, even amongst those that voted for unchanged rates. It feels like there were 5 members, I guess, leaving aside Dingra, who we know sits at the very dovish end of the spectrum. But it feels like there were 5 members that were still concerned about the kind of risks of second round effects and the upside risks, stemming largely, I suppose, from the tightness of the labour market in the UK and the potential for kind of early 2024 wage negotiation rounds driving another leg higher in inflation. Yeah, that was kind of the first key takeaway for me, was the nervousness, or the tone in the minutes around the nervousness of potential upside risks to inflation. And the second thing, which was new really in this set of minutes, was the efforts that the Bank of England went to set themselves apart, particularly from the Fed, but I suppose in some ways from the ECB as well. There was lots of comparisons, which we hadn't seen in the November minutes, for example, between the inflation outlook in the UK versus the US and the Euro area, between the tightness of the labour market, between the downtrends that we've currently seen in inflation in the US and the Euro area versus what we're seeing in the UK. And I think that there was a very clear message from the Bank of England amongst all of that, we might have seen a bit of a dovish shift from the Fed, but we are not the Fed, and we're still towing this very hawkish kind of restrictive for longer narrative, which is much more hawkish, I would argue, than we've heard from other central banks this week.
So I guess the same question for you that you asked both me and Jan. So how does this leave you in terms of your views on the market and into the next year?
I guess given that this was very much in line with our expectations, it doesn't change my market views at all. I think given those kind of two key takeaways from a market perspective that I just went through, they combine to reinforce the cross-market underperformance of gilts that we're expecting. I think are still hawkish, or a hawkish outlier of a central bank that is retaining this kind of restrictive for longer narrative, that is emphasizing the upside risks around inflation, and is therefore probably going to be the last one to cut rates, will drive some underperformance. But also, to the extent that part of what is driving our view that gilts should underperform on a cross-market basis is to do with the fact that we think that the supply-demand imbalance probably weighs slightly heavier here in the UK. Well, if we're starting to see central banks pivot earlier in other regions, and markets are more comfortable that inflation is on a sufficiently downward trajectory in those other regions, I think you see a bid for duration return more quickly in those other regions. So not only do you naturally get central banks keeping, or a more hawkish central bank keeping rates on hold for longer, which will drive some underperformance of gilts, but I think it also worsens this supply-demand imbalance, which we expect to drive underperformance kind of further up the curve, rather than just concentrated in the very heavily sort of monetary policy influenced front end of the curve. The other key takeaway is just, I think, something we've spoken about on this pod before, but I think that markets are still underestimating, or current market pricing for bank rate expectations looks stretched, should we say. And by that I mean that it is not our base case that the Bank of England is going to need to deliver any additional tightening. Far from our base case. I think I would probably put the probability of another hike in Q1 next year at something like 15 to 20% maybe. But that compares to market pricing of about 10-ish basis points of a cut by March. So, I think that markets are underestimating those upside risks, and that I think that kind of having a 33% likelihood of a cut as early as March feels too high for me. And I would kind of fade that near-term market pricing. So whilst, we have 100 basis points in our central scenario of cuts next year from the Bank of England, and that's not all that far from where the market is now. I think just the timing of those cuts is perhaps a little bit different to what we're expecting. And just to echo the comments that you and Jan have made, we've moved very far, very fast. And if that pricing isn't justified anywhere, I think it's in the UK. Going back to the points that the Bank of England made, the inflation outlook is still, or the inflation data is still quite different here in the UK, where we're seeing broad-based disinflation in the euro area. Actually, all of the reduction in inflation that we've seen from kind of double digits to now sub 5% in the UK has been driven by energy and food price base effects. Service price inflation is still very high, much higher than the Bank of England's target, and remains sticky. And that was one of the things that Governor Bailey highlighted today in the minutes. And I guess importantly, he highlighted any reduction that we have seen in that service inflation basket has been coming from the more volatile components, which aren't necessarily indicative of a kind of trend going forward. So there's still different inflationary pressures. The labour market is tighter. Wage inflation is still very high. We got very excited, or the market got very excited this week about a downside surprise on wage inflation. But wage inflation still at 7% is much too high for comfort for the Bank of England's 2% target. And I just worry that we've moved so far, so quickly in the UK, which is not being endorsed by the Bank of England, and we expect the Bank of England to remain very hawkish relatively hawkish for the months to come. That I think these kind of stretched market moves are perhaps vulnerable to a little bit of a reversal. Maybe not immediately. Liquidity is clearly going to dry up over the next couple of days as we head into the holiday period, and once the Bank of Japan's out the way, there's no huge kind of risk events on the calendar. So maybe this is a Q1 story, once we all come back to the market and again there's a bout of fresh supply for the market to absorb. Maybe that's when we start to see a bigger backup in rates, but I think that's the way that the risks are skewed right now. Anyway, that's enough from me, and we can round out our last episode of 2023 there. Thanks to you both for joining me. Thank you to our listeners for listening today and all throughout the year. We hope you have an enjoyable and restful holiday period, and we'll be back in January with more insights and takes on what the latest market moves mean for you. That's all from us this week. Have a good holiday, and we'll see you in the new year. Thanks.